Liquidity and funding, key concepts and strategic management. Understanding liquidity's role in financial health. Agenda. Understanding liquidity, sources of funding, liquidity management strategies, funding strategy and planning, regulatory environment and compliance. Definition and importance of liquidity. Understanding liquidity. Liquidity is defined as the ability to quickly convert assets into cash without a significant price impact. Importance for companies. Maintaining liquidity is crucial for companies to meet short term liabilities and ensure smooth operations. Types of liquidity, market and funding. Market liquidity. Market liquidity indicates how quickly assets can be bought or sold without significantly affecting their price. Funding liquidity. Funding liquidity refers to the ability of liquid assets to meet short term financial obligations. Importance of liquidity. Both market and funding liquidity are essential for maintaining the overall financial health of businesses and investors. Liquidity ratios and metrics. Current ratio. The current ratio measures a company's ability to pay short term obligations with its current assets. A higher ratio indicates better liquidity. Quick ratio. The quick ratio, also known as the acid test ratio, assesses a company's ability to meet short term liabilities without relying on inventory. Financial stability. Understanding liquidity ratios is crucial for evaluating a company's overall financial stability and operational efficiency in the market. Internal sources, retained earnings, and asset sales. Retained earnings. Retained earnings are profits reinvested into the business, providing a stable source of internal funding. Asset sales. Asset sales can provide immediate cash flow and are an important internal funding source for businesses. Lower risk funding. Internal funding sources such as retained earnings and asset sales are often lower risk compared to external funding options. External sources, debt and equity financing. Debt financing. Debt financing involves borrowing funds through loans or bonds, which must be repaid with interest. This method allows businesses to access capital without giving up ownership. Equity financing. Equity financing involves selling ownership stakes in a company in exchange for capital. This can lead to dilution of ownership but does not require repayment. Risks and benefits. Each type of financing carries its own risks and benefits, influencing a company's financial strategy and overall operations. It's crucial to evaluate both options carefully. Alternative funding sources, crowdfunding and venture capital. Understanding crowdfunding. Crowdfunding allows individuals to contribute small amounts, collectively funding projects and innovations through online platforms. Venture capital insights. Venture capital involves investments from firms targeting startups and projects with high growth potential and scalability. Innovative financing methods. Both crowdfunding and venture capital offer innovative financing methods that empower entrepreneurs and startups in their growth journeys. Cash flow management, tracking cash inflow. Monitoring cash inflow is essential for understanding revenue streams and ensuring operational liquidity. Managing cash outflow. Effective cash outflow management helps organizations control expenses and allocate resources wisely. Ensuring liquidity. Maintaining sufficient liquidity is crucial for meeting obligations and avoiding cash shortages. Investing in growth. Optimizing cash flow allows organizations to invest in growth opportunities and strategic initiatives. Asset liability management, financial risk management. Understanding and managing financial risks associated with asset liability mismatches is crucial for organizational stability. Meeting obligations. Effective asset liability management ensures that organizations can meet their financial obligations in a timely manner. Optimizing returns. Strategic management of assets and liabilities helps organizations optimize returns on investments while minimizing risks. Contingency planning, prepared for unforeseen events. Contingency planning is essential for preparing for unexpected events that may disrupt financial stability or operations. Mitigating risks. A robust contingency plan allows organizations to mitigate risks effectively, minimizing potential negative impacts on liquidity. Ensuring stability. Contingency planning helps ensure business stability during economic downturns or operational disruptions, maintaining liquidity and operational integrity. Strategic planning for funding needs. Identifying funding needs. Strategic planning involves identifying specific funding needs to ensure financial stability and growth for the organization. Forecasting capital requirements. Accurate forecasting of capital requirements helps organizations prepare for future funding and investment opportunities. Supporting growth and efficiency. Proactive approach to funding through strategic planning supports organizational growth and improves operational efficiency. Optimizing capital structure, debt and equity mix. Finding the right mix of debt and equity financing is crucial for minimizing costs and maximizing company value. Financial flexibility. An optimized capital structure enhances financial flexibility, allowing companies to adapt to market changes effectively. Sustaining growth. Maintaining a balanced capital structure is key to sustaining growth and ensuring long term financial health. Balancing risk and return. Understanding risk and return. Organizations need to understand the relationship between risk and return to make informed financial decisions. Assessing risk tolerance. Evaluating risk tolerance is crucial for aligning funding strategies with organizational goals and capacities. Sustainable financial health. Finding the right balance between risk and return ensures the long term financial health of an organization. Regulatory requirements for liquidity and funding. Liquidity regulations. Liquidity regulations are mandated to ensure financial institutions maintain sufficient cash flow to meet obligations. Funding requirements. Funding requirements dictate the necessary capital reserves that institutions must hold to support their operations. Importance of compliance. Compliance with liquidity and funding requirements is crucial for maintaining operational integrity and earning public trust. Impact of regulations on financial strategies. Effect of regulations. Regulations impact financial strategies by limiting liquidity and available funding options for organizations. Adapting to compliance. Organizations must adapt their financial strategies to comply with regulations while also seeking growth opportunities. Compliance and reporting. Importance of compliance. Regular compliance checks are vital for organizations to adhere to regulatory standards and avoid penalties. Transparency in practices. Transparency in financial practices is essential for building trust and confidence among stakeholders and investors. Accountability measures. Implementing accountability measures ensures that organizations remain answerable for their financial actions and decisions. Conclusion. Importance of liquidity. Liquidity is essential for organizations to meet their short term obligations and continue operations smoothly. Funding sources. Organizations must identify diverse funding sources to support growth and operational needs effectively. Financial health strategies. Implementing effective financial management strategies is crucial for maintaining overall financial health and competitiveness. Thank you.